Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young. Today is January 23rd, 2025, and today we're going to make a case for bonds or going long bonds in this market that's pushing to highs. Now, a couple things we want to note. You might see or notice that I'm on the VIX, the volatility index or the volatility measurement, showing us that overall volatility is low. In fact, we're pushing back to the previous low support levels through here. There's an old ad that said, when the VIX is low, it's time to go. When the VIX is high, it's time to buy. And the idea there is not just if the VIX is high or the VIX is low relative, is the VIX low and turning back up, or is the VIX low at a key low spot, not just low generally. If the VIX is high and reversing, then it's time to buy the market, meaning volatility has reached its peak, likely to fade, and people are going to step back into bullish plays. So the VIX being at this level is kind of the support level that we had other than December. December was very, very low. We didn't have a lot of activity. We had lighter trading volume as we went into the end of the year, and that wasn't a surprise. But this VIX falling down back to this previous low through here, I think this is a good key level, about 1390 to 14. And today's shadow tried to push lower. So it tells me we're getting close to this area that if the VIX is low, it's time to go. In other words, if the VIX is low and at a key support level, we're looking to avoid risk. We're looking to avoid risk and probably look for safer trades. Now, if we tie that into what we've already seen happen in the bond market, we go over to the Z-end, for example. The Z-end is the bond futures. The Z-end was in this downtrend. I was tracking this channel when it broke out. It went that channel distance, dropped back down, found the low of the channel, broke the channel, and is retesting that old breakout resistance as support. Now, that's not all that I'm seeing in here. It also looks to me that we are forming a potential, and I always call them potentials because price patterns are potential price patterns until they break resistance or support. So as I'm looking at this, I'm looking for this area through here and saying this would be your left shoulder, this could be your right shoulder, and if that's the case, we look for the distance from here to duplicate and probably get up into this area where we're talking about a return back to December highs. Now, bonds bouncing off of this old support level also say that it's probably going to defend or trade the same channel and move to that level, next level higher. And that channel is going to set us up for a move. It says 1 point and 1630 seconds, and we'll just duplicate it and move it up here. Now, you might be looking at this and say, but Blake, I don't want to trade bonds. I don't trade bond futures. That's fine. What we're looking at is going then to something like an IEF, the 7 to 10 year bond future. You're going to see a similar pattern, left shoulder, head, right shoulder, as far as the inverted head and shoulders. And now we have a dollar amount we can deal with. And you'll also note that the IEF low with the gap ties back to these lows. And the gaps are not real. I always say gaps are not real because what you're doing is you're just missing seeing the trading that happened. And that trading happened in the overnight, which arguably was Europe buying into US bonds, or the UK buying into US bonds, pushing prices higher. So that you need to treat that gap as a great big bright green candle in that move. Now the move there takes us from 91 to 93. We're looking for a move up to 95. And now we're talking about a 2-point move and looking for a significant climb in IEF. Now, IEF also pays a dividend of 4% as it is a substitute for the 7 to 10 year treasury bonds. So you get a 4% dividend while you're watching price climb, a potential 3.5%, 4% that likely could happen in the next month. So I like that overall. But the sentiment is also something that I pay attention to. If the sentiment holds that we are seeing risk avoidance or seeking what I will call a risk-free return or risk-free premium, then as many of you know, I like to look at fixed income substitutes such as utilities. And utilities have not been pulling back this far, but are setting up for the next move as well. And as you can see on XLU, the utility ETF that includes multiple ETFs and multiple utility stocks. As we're looking at this, we have an inside day. I would call this a bullish harami because we already created the base, similar to what we saw in bonds. We shot higher, pulled back, and today is an inside day or bullish harami that says if we trade above tomorrow, if we trade above this high, then we're looking at a continuation likely back to 83. And now we're talking about an 8% climb while also getting that dividend payment on utilities. There are individual stocks inside of XLU that could be very beneficial to trade that give you a good premium and growth as well. CEG has never slowed down. We've talked about this in the past. VST is also pushing up to multiple year highs and breaking out. And so these are great. It's just a little hard to catch them as they run. So we want to look for the ones that are maybe discounted a little bit and setting up for the next move. And I would say Nextera is probably one of my favorites to trade because it moves clean, and even with this pullback, you can see that we pulled back inside the gap. We created that inside little harami again. We do have earnings, so be aware of that. But it looks very bullish here as an opportunity, and if we get past earnings and it's a good earnings, then we would look for a move to 73, likely to 80, and now we're talking about a 12% move in the underlying price plus a 3% dividend yield. If you're worried about the earnings, then wait till after earnings to trade NEE, but you might look at something like Dominion. You have a couple of extra days before you have earnings, and if we benefit, we have the same support level and inside a huge sell-off right down to that low. Not a lot of risk to be able to buy here. If it bounces, target 156, target 260. And if we go to 60, now we're talking about a $6.5, $7 move. And again, 12 to 15% return and a 5% dividend yield annually if we hold on to it for the time being. If you're not in love with utilities, the signal is still there. Low volatility. If we see that volatility bounce, then we will likely see some profit taking, some reversals. And if that's the case, then we're going to look for more secure, safe plays. And that would be going and looking at some of those dividend aristocrats instead of just utilities. And those dividend aristocrats are stocks that have increased their dividend year over year and have been consistent about increasing those dividends over the last 25 years. So we'd still be looking for Cokes and Pepsis and AT&T. But some of the ones that we maybe don't look at are things like Franklin Resources, which has a 6.5% yield. Also has earnings come up, so be aware of that. But the cost of this is relatively low for something that pays out a 6.5% dividend yield. Something like Realty Income Corp. You take a look at theirs, and they have also paid out a high dividend. And you'll see a similar pattern to what we just saw in utilities. The bounce, the breakout, the pullback, the doji, or the harami inside day, and a move back up to 58 would be about an 8% move. And if we can get back up to the previous highs, we're talking about nearly a 20% increase plus a 5.8% dividend yield. We could take something like AMCR, similar little pullback, a nice opportunity there. Be aware, a lot of these have earnings coming up, but if we're trading these for the long term and for the big long-term dividend payments, then we're not going to be overly concerned about holding it over dividends. You just have to be aware that you might want to use your dividend payment that is coming up to pay for a protective put to go over those earnings. So giving up a quarter's worth of dividends to protect against those drops can be a strategy you can use here. Last two, T-Row. Similar pullback through here as well. Not a bad price at 112 if it goes to 126. Sizable return plus a 4.3% dividend. And one that kind of misses attention is Smuckers. And Smuckers have been discounted way down to 102, so way off its highs, but they do pay a 4% dividend. So a 4.25% dividend down here near the lows. Not a lot of risk to trade it down to the lows, but an opportunity that could go from 102 to 120. Get a 20% return plus a 4.26% annualized return. So this is my argument. This is my case for the idea of stepping into stocks that are going to give you a slow, steady return. You're not looking for normal big moves, but we're priced right where we could see big moves and big dividend payments in utilities, in bonds, and in the dividend aristocrats. That's going to do it for me today. Join me and Brandon again tomorrow morning as we discuss the week and some of the things that happened with the Bank of Japan and some new opportunities in oil prices. Thanks, and we'll talk to you again tomorrow.